Hello students, welcome to Drishti IAS. My name is Saloni Nandkyolier, and in this session we are going to talk about the new insurance bill of 2025. So this bill has been approved by the Union Cabinet and now this is all set to be tabled in the Parliament. So in today's session we will look at the key provisions of the bill and we will also discuss some major omissions in the bill. So let's begin. This new insurance bill is also being called सबका बीमा सबकी रक्षा सबका बीमा सबकी रक्षा amendment of insurance laws. सबका बीमा सबकी रक्षा amendment of insurance laws bill 2025. Now you might be wondering what was the need to introduce this bill. So basically all the existing laws that we had for the regulation of the insurance sector in India, they were all very old and very outdated. Just to give you some examples, we had an insurance act. There is an insurance act in India which dates back to 1938. Pre-independence Insurance Act dates back to 1938. Similarly, we also have the LIC Act, which dates back to 1956. Again, very old. Then we also have an act for the Insurance Regulatory and Development Authority of India, the IRDAI Act, which again is quite old. 1999. So all the laws that we have for the regulation, for the governance of the insurance sector in our country, they are all very old, and that is why there was a need to modernize this sector by bringing about these new laws. Times are changing, requirements are changing, and that is why there was a need for the modernization of these laws. That is why the new insurance bill is going to be introduced in the Parliament. Now if I talk about the key provisions of this bill, the most important provision over here is about the foreign direct investment. The FDI has been allowed to 100%. 100% FDI in the insurance sector is now going to be allowed from the existing 74%. It has been upgraded from the existing 74% to 100%, which means that the foreign insurers can now have up to 100% stakes in the Indian insurance companies. Earlier, this was only 74%. Now, this has been increased to 100%. And this is going to do what? It will ensure more insurance penetration in the country, and in the long run it is also going to bring in long-term foreign capital into the Indian markets, which is very much required for the growth of Indian economy. So FDI, increasing the FDI to 100% is a great step over here. And then reduced capital requirements for reinsurers. Now who are these reinsurers? Reinsurers are the companies who basically provide certain insurance to the insurance companies. They hedge the risk of the insurance companies so that if there's any disaster, the main insurance company does not basically suffer a huge setback. They take up some risk of the insurance companies. These are the reinsurers. So earlier, these reinsurers needed to have a capital requirement of 5,000 CR. They should have had net owned funds of 5,000 CR, and now this requirement has been drastically reduced. Now instead of 5,000 CR, the new capital requirement is 1,000 CR, and this is going to allow small players also to enter the Indian insurance market. Earlier only very big players could have entered the market. Now small players can also enter the Indian market. Then powers have been enhanced for IRDAI. More regulatory powers, stringent powers have been provided to IRDAI. For example, IRDAI can now even take away the illegal profits that any agent or any insurance company makes. For example, if any agent or any insurance company has made any profits by cheating a customer, then the IRDAI can even demand the agent or the insurance company to give back the illegal profit that they have earned. There are certain laws for that, but basically IRDAI has now been given these powers that can at least get the illegal profit back from the agent or back from the insurance companies. So better enforcement powers and enforcement have been given to IRDAI. Secondly, earlier IRDAI could have approved equity transfers or share transfers of up to 1% only. Equity transfers of up to 1% only, and now this limit has also been increased. From 1%, they can now approve equity transfers of up to 5%. So this is going to save a lot of approval time, and it is going to help the companies in doing their business. So the ease of doing business is going to increase. And then greater operational freedom has been provided to LIC. The Life Insurance Corporation of India has been provided with more operational freedom. Earlier, in order to run or set up a new branch in India, LIC would have to take approval or permission from the government of India every time. Now they don't need to do that. They can set up new branches, they can run new branches without taking approval from the government of India every time. And at the same time, they can also run their branches on foreign land. By complying to the local laws of that company. So more autonomy has been given to LIC. LIC is the largest insurance provider in India. So more autonomy has been given to LIC. More operational freedom has been given to LIC for better administrative efficiency, for faster procedures, for better operation, and lesser delays. So what has happened? FDI in insurance sector has been increased to 100%. Then the capital requirement for reinsurance has been drastically reduced from 5,000 CR to 1,000 CR. More stringent laws, more enforcement powers have been given to IRDAI, and greater operational freedom has been provided to LIC. These are some great initiatives that have been introduced in the law, but then there are some loopholes also. There have been some major omissions. If I talk about the major omissions, the first and the foremost one is that there are no composite licenses. Composite licenses have been a demand of the insurance sector for a very long time now, but again, no composite licenses have been provided in this law. So what do you mean by composite licenses? Currently, what is the scenario in India? If there is a life insurance company, then that life insurance company is only going to sell you life insurance. It will not sell you car insurance. It will not sell you health insurance. It will only sell you life insurance. So life insurance companies will only sell life insurance products, and non-life insurance companies will only sell non-life insurance products. They will not sell life insurance product. So there is no composite licensing that we have in India. So life insurance plus non-life insurance cannot be provided by one single company in India. This is the scenario at the moment, but there have been talks about introducing a composite license so that one company can offer you multiple products, and this is also going to increase their profits, and at the same time more players can enter the market. This is going to give us better competition, lower premiums, better products, etc. But right now there is a loophole that a life insurance company will only sell you life insurance products. It is not going to sell you any non-life insurance products. Then there is no reduction in capital requirements of insurers and reinsurers in India. For insurers, the capital requirement is 100 CR, and for reinsurers, the capital requirement is 200 CR. Domestic insurers and domestic reinsurers, the capital requirement for them has not been decreased. It still remains the same. So this again is not going to allow small Indian insurers or small Indian non-insurers to enter the insurance market. And nothing on captive insurance has been said. Now, what is captive insurance? captive insurance is basically a form of reinsurance that one company provides to itself. So what happens in reinsurance? Basically, an insurance company is going to take an insurance from some other company. Now in captive insurance, that insurance company is going to take an insurance from its own wholly owned subsidiary, its own captive insurance company. It is not going to take insurance from any other company. This main insurance company is going to set up a captive insurance company which is only going to provide insurance to that main parent company. This is known as captive insurance. This is a very common practice in the West, but in India, we have no laws on this. We have no rules on this. We do not, there is no clarity if this is legally recognized or not, formally recognized or not. Captive insurance, again, is a major miss in this law. Nothing has been talked about captive insurance. But if this happens, this basically helps the parent insurance company save a lot of money because they're not dependent on any third party. There is no middleman in between. They're setting up their own captive insurance company which is going to be customized to suit to their needs only. So captive insurance is something that's a very common practice outside because of the great benefits that it has, but nothing has been said on this front in our bill. So these are some major loopholes or major misses in the bill. What are those misses? There is nothing on captive insurance. Then the capital requirements for our domestic insurers and reinsurers, they have not been reduced, and then there is no composite licensing that has been provided for our insurance sector. So there are some good things, there are some bad things that have been introduced in this bill. Let's see what happens when this is passed. But that was all for this video. Now let us look at a practice question for prelims. With reference to the Insurance Amendment Bill 2025, consider the following statements. 1. The bill permits up to 100% FDI in insurance companies operating in India. 2. The bill introduces composite licenses allowing insurers to offer both life and non-life insurance products under a single entity. 3. The bill provides a comprehensive legal framework for captive insurance companies to operate within India. Which of the statements given above is or are correct? A. 1 and 2 only, B. 2 and 3 only, C. 1 and 3 only, or D. 1 only. Please provide your answers in the comments section and we will meet in a new video. Thank you for watching.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.